Bismillah ar-Rahman ar-Rahim. Alhamdulillahi Rabbil Alameen. Sallallahu ala Sayyidina Muhammad wa ala alihi sahbihi ajma'een. Alhamdulillah. Welcome to part 3 of our discourse on the history of riba. And in the previous discourse, we had kind of ended with kind of charting this progression of how interest was increasingly being seen to be accepted, and we culminated with the Protestant Reformation, which kind of made a demarcation between usury and interest, whereby usury was now redefined to be exorbitant rates of interest, and interest in and of itself up to a certain percentage, some said 5% within the Protestant kind of movement, was considered an acceptable amount to charge. And this culminated in the 1545 Act, an act against usury of King Henry VIII, in which usury was explicitly defined as being a certain amount. I think it was 10% above interest. And so what I wanted to point about this was that with this societal tolerance of riba, of interest now, we have other kind of innovations start happening. One of the key innovations was, and this would happen later, was increasingly the justification for commerce was being seen to be self-interest. And this would later transpire in the economic thought of someone like Adam Smith, who would borrow, ironically somewhat borrow, this is the opinion of David Graeber, the financial anthropologist, that Adam Smith actually borrowed a lot of his analogies from the works of Imam Abu Hamid al-Ghazali and Nasir al-Din al-Tusi, because he had these Latin translations of these Persian works. And so he would literally borrow these analogies that he took from, such as the division of labor, from Imam Ghazali. So Imam Ghazali used an example of a needle factory, and he used the example of a pin factory. But he then changed Imam Ghazali's view on how markets work. Because Imam Ghazali's view was that markets work on the premise of mutual cooperation. Now, what Adam Smith did is that he said it was only premised on selfish gain. Now, this is very important, because what begins to emerge in the dimension of looking at on the what we call the meta principles of money, is that we begin to see this kind of economic thought. And prior to Adam Smith, there was obviously famously Thomas Hobbes, who published his book, The Leviathan, in which he basically said that that given people, unlike if they're not controlled, would resort into relentless materialism. I mean, Hobbes basically saw people as basically machines, and the only one single principle that they had was that they moved towards the prospect of pleasure and away from the prospect of pain. To him, human beings are all ultimately driven by self-interest. And so, whilst as we discussed in the previous section, people like theologians like Martin Luther King were using arguments a century earlier to Hobbes about, almost a justification for a relaxing on the prohibition of usury from a libertarian perspective, to accept that people are going to ultimately act that way. Thomas Hobbes would start replacing this theological language now with supposedly a scientific language. And so this discourse of self-interest comes in. And it's interesting that they use the word self-interest, as David Graeber notes, because they did directly actually borrow the term self-interest from the word interesse, that word whereby interest has arose from. Interesse, of course, was the Roman law term for interest payments, basically late payment charges. But Thomas Hobbes would start using it, and this supposed penalty for a late payment then translates into a kind of mapping of human personality, making it look like, this is somehow an objective idea that ultimately we're all only pursuing our self-interest. And so this obviously found itself in the deeper articulation of how economics would come to evolve. But what I wanted to touch upon is this interesting quote from David Graeber from his book, Debt, the first 5,000 years. And he states that the story of the origins of capitalism then is not the story of the gradual destruction of traditional communities by the impersonal power of the market. It is rather the story of how an economy of credit, right, by which credit he means this mutual trust, because people would be happy to be in credit with each other, was converted into an economy of interest. He says, of the gradual transformation of moral networks by the intrusion of the impersonal and often vindictive power of the state. And so what people like Thomas Hobbes argued was that if it wasn't for the state, then inevitably human beings would resort to war of all against all, a Hobbesian war. And it's very interesting that that was his view of humanity, whereas the view of humanity of the Islamic world was the exact opposite. They had demonstrated over the course of centuries that, that human beings can function without the overpowering nature of the state, but they themselves function on the premise of mutual credit and trust. But the resultant dimension of this resulted in, of course, Adam Smith famously saying that, in his quote, "It is not from the benevolence of the butcher, the brewer, or the baker that we expect our dinner, but from their regard to their own interest. We address ourselves not to their humanity, but to their self-love, and never talk to them of our own necessities, but of their advantages." So this is a very, for want of a word in Arabic, we would call it nafsani view. And so Graeber touches upon and how Smith simply imagined this kind of dimension of money and his imagination of the origins of money, because it gave him a premise to ignore the role of benevolence in economic affairs, and how the ethos of mutual aid was originally that which formed the necessary foundation of the world's first free market, free economy, and that was the Muslim world, right? And so now what starts happening now is that we start seeing this kind of evolution. And so this evolution now operates on a premise of division and selfishness, right? And so the origins of modern banking illustrates how closely, and we'll cover this in the next session, of how war and these new innovations go together. But what starts happening, and I touched upon this in the previous thing, of how these kind of banks, especially in northern Italy, started taking over the power of the state, so that would relieve and give them the ability. And obviously Medici Bank was one of the most prominent in that sense. And the Medici Bank actually also took over the papacy, in the sense that they entered into a partnership with the church, the Catholic Church, and two of the original popes were directly from the Medici families. So the origins of the Medici Bank also played an origin of some of what we come to understand paper money today, because it was through their financing, and specifically financing the Venetian government in the 12th century, whereby they started funding, usually for military purposes, a kind of what created this sense of a bond or a contract that was then traded in the secondary market. And so what started happening is the Medicis would fund the government needing a quick infusion of income, would then level a compulsory loan on the tax-paying citizens, but would promise each of them 5% annual interest. And these promises, or these bonds, then became negotiable. And so this created a market in government debt. And so effectively, the Venetian state was agreeing to pay, and again, this was interesse, this kind of penalty for late payment. It was agreeing to pay a penalty on itself. But this starts exchanging, and these kind of debts start piling across, even get traded across Europe. And so Graeber notes that by 1650, a majority of Dutch households held at least a little of government debt. And so the real paradox started to appear when they would monetize this debt. That is, they would take these government promises and allow them to circulate as currency. So what started happening, very interestingly, and this is the birth of the first, you could call it an interesting innovation, whereby there were multiple currencies in exchange in Amsterdam. And of course, there would be sometimes problems with the bullion and which currency was considered more valuable, and sometimes there'd be problems. So what started happening is people started putting their currencies, or if it was gold or silver, or they would leave them with the Amsterdam Exchange Bank, the Wissel Bank. And the Wissel Bank resolved these problems of this circulation of multiple grades of currencies by issuing certain standardized documents. And so it pioneered the system of checks and direct debits or transfers that we take for granted today. And merchants began trading in these documentary kind of certificates. So one merchant would make a payment to another simply by arranging for his account at the bank to be debited and the counterparty's account to be credited. And so Niall Ferguson, in his book, The Ascent of Money, says the only limitation on this was that the exchange bank maintained close to 100% ratio. So it was, literally keeping a ratio of the gold or silver matched to these, so the precious metal and coins were being matched to these kind of deposits. And so, it was very possible that a run on the bank could happen. Now, the next major innovation, what prevented the bank, usually a run on the bank, was that it always had enough cash to satisfy nearly all of its depositors. And so it was relatively secure. But what happened after that, which is very interesting, was that in Stockholm, a bank, the foundation of what they call the Stockholm Banco, this was in 1657, and it basically also started printing notes in 1661. This was the first idea of what we would understand as fractional reserve banking, whereby it started lending money based on what it didn't have, based on a fractional reserve. So it would exploit the fact that the money was left with it on deposit, and they would think that at a certain point of time, not everyone's going to come and take the money. So they would lend out what they had, and it was unlikely that depositors were en masse, together at one moment going to come and take the money. So only a fraction of their money was needed in the reserves at any time. And so this way it started giving these loans out. And this became a very prevalent practice. This was in 1657. And this kind of spreading of this thing had set into play what Niall Ferguson touches upon as, once we understand that there is a cashless intra-bank and interbank transaction. So without cash, people can just net off their transactions. This is the first thing. Two, now there is a fractional reserve banking. These are the two pillars. Then the only thing that's left now is the third major pillar, which is the evolution of the first central bank. And that is what happened in 1694. So I will touch upon that. But before that, I wanted to just touch upon this idea of the another interesting kind of evolution that happens in Holland, what we know as Holland today, and that was the first joint stock company. Now, so this was an idea of how basically through this funding of banks, many people were engaging in trade, and they were spreading out these kind of missions to kind of go and deal with kind of different areas of trade. So the Wissel Bank, having created this kind of engagement, allowed for what was the different, at that time, there existed different East India companies, because they would call themselves East India companies because they were operating out of the major Dutch ports. But then somebody basically said, look, if you're going to go there and this is going to be a risky journey, and this is a long duration of the voyage, then the only way this business model can survive is if all of these companies would be merged into one. And the result was what they call the United East India Company. Right? In Dutch, it's known as Verenigde Nederlandsche, I can't even pronounce the last word, but generally it comes to VOC for short. And it was formally chartered in 1602. But the structure of the VOC is actually the first instance of what we would call a joint stock company, because essentially they had all of the money was then distributed even amongst the certificate holders. So the shareholders and this idea of principle of limited liability became to be implied, because the shareholders only stood to lose their investment in the company, but their own personal assets would not be affected. And there was also no guarantee of return, because what was implied was that the payment would be made to the shareholders only when the profit is accrued, right? And it wasn't guaranteed. And so what happened was that when this shares started coming to being, this kind of promise of returns, then when the bank existed, the bank was existing at the same time, the Dutch bankers began to start to accept these VOC shares, the shares of the company, as collateral for loans. And so the link between the stock market and emerging stock market and the supply of credit coming through this bank had been forged. And so the next step, as Niall Ferguson notes, was just for the banks to lend money so that the shares could be purchased with its credit. And then before you know it, the company, which is the VOC company, East India Dutch Company, the bank and the people were tied in a triangular formulation that promises a new type of company. And so that was interesting, because we're in that the Dutch East India Company, and later on obviously the East India Company and so on, you see the first premises of how this system starts evolving in a kind of outward imperative colonization. And I'll cover that in the next presentation. But it's interesting now that in 1694, the situation is being set up for the evolution and the creation of the first central bank. So we've already said people are increasingly theologically and also philosophically accepting the idea of printed interest. There's already been an implementation of fractional reserve banking in Stockholm, and there's already been an implementation of credit in the sense of netting off credits of customers in banks and the idea of paper money. And so what happens is, as these increasing banks, effectively goldsmiths, start accepting more and more receipts in lieu of gold, then what happens is that people, when they put the gold in, they would get the receipts. But then these receipts were payable to the bearer of the receipts. So anyone who gets the receipts could go and get the gold. And as a result, what they do, they start trading amongst themselves. So as the goldsmiths' names and receipts become more common, people leave the gold and just use the receipts as money. Now, what happens after that is that, to go back to that principle of what we said, the withdrawals and fresh deposits are now netted against each other. And so at any time, only a small portion of the gold holdings were redeemed. And this is where the fractional reserve banking comes in. This is when the goldsmiths hit upon an idea. And what is that idea? That now, if people are accepting these receipts as being money, then the goldsmiths have the ability to literally create money for themselves. But you see, if they created this money and they spend it into the economy by just buying things, then sooner or later these receipts would come back to themselves right here, and they would be looking for the gold in turn. People are going to say, here's the receipt, give me the gold back. But so at that point, this gold would run out, and the goldsmiths would be caught, and they would go bankrupt, and they would be caught as frauds. So the idea that they hit across, the idea that they got, literally the idea, and this could be called perhaps the most biggest business idea in the history of mankind, considering that it led to the formation of commercial banking as we know it, was instead of spending these receipts into the economy, they lent it into the economy. So what is the difference? By lending it into the economy instead of spending it, they are bringing these receipts into existence, these receipts here. But unlike these receipts, which are backed by gold, these receipts are backed by nothing. They've literally been created ex nihilo. Ex nihilo means created out of nothing. The fact that they've been created out of nothing means as and when the time comes to pay them back, right? As and when the time comes to pay them back, they can be destroyed by the goldsmiths. But you see, the goldsmiths, if they were simply lending money and getting that same money coming back, i.e. these same receipts coming back, then they wouldn't benefit by this scheme. But it was the interest that they charged, right? It was the interest that they charged that made them become a bank. Some of you may have missed that. Again, if you just see the word goldsmith there, as soon as it comes back, it becomes a bank. In other words, they hit upon an idea that made them extraordinarily rich. And this ability to get money out of nothing, the only thing stopping them from failing was if they, they made sure that there's a certain ratio and this gold is there at the level of the reserve, and they could keep playing the game and they would get the interest. Now, where would this interest come from? Because this interest is an extra amount of their charge that supposedly would come not from this section of receipts that they created, because these are the ones they created out of nothing, but from that section of receipts, which are actually backed by gold, which means that this interest is an extra charge on this section of receipts, right? That they've been justified to include and charge the people. But where are the people going to pay this extra charge from if it itself was created out of nothing? It means systemically, one or someone of this group has to lose for this bank or the goldsmiths to win. This is what's known as a zero-sum game. And brothers and sisters, this is exactly how banking works today. And so in 1694, we see the birth of a new type of money. And this is what David Graeber touches upon in his book when he says, it was only with the creation of the Bank of England in 1694 that one can speak of genuine paper money. Since its banknotes were in no sense bonds, they were rooted like all others in the king's war debts. What does that mean? Because what happens in 1694 is having the goldsmiths becoming very, firstly there was, this is just a chart that I put together, but once we find that interest becomes permissible, and then the birth of modern banking starts happening through some of the reforms I highlighted, then in 1694, King William, who wants to fight a war of succession, doesn't want to raise money through his taxes, but he wants a loan. And who gives him the loan? These powerful goldsmiths. And when they give him a loan, they basically ask him to nationalize the debt, by which they mean that in return for this loan, they want the right to constantly create this money through the first independent central bank, and they gain the right to print this paper currency in the name of the king, and they continually get the interest on it. And about this thing, David Graeber says, it was only with the creation of the Bank of England in 1694 that one can speak of genuine paper money, since its banknotes were in no sense bonds. They were rooted like all others in the king's war debts. This can't be emphasized enough, the fact that money was no longer a debt owed to the king, but now actually became a debt owed by the king. It was based on the king taking this loan that these bankers or the goldsmiths got the ability to create a central bank. And this now made it money very different from what it had been before. In many ways, it had become a mirror image of older forms of money. This is very, very important to understand, because this money that was created from 1694 is still our money today. And so the Bank of England, this Bank of England was created by a consortium of 40 London and Edinburgh merchants. Most of them were the goldsmiths. They were already creditors to the crown, but they offered King William III a 1.2 million loan. And that 1.2 million loan helped finance his war against France. But in doing so, they also convinced him to allow them in return to form a cooperation with a monopoly. This is what we know as the first Bank of England, the central bank, on banknotes, on the issuance of banknotes. These banknotes were now promissory notes for the money the king owed them. This was the first independent national central bank, and it became the clearinghouse for debts owed between smaller banks, and notes soon developed into the first European national paper currency. And so by this way, money becomes issued by the central bank, obviously becoming a clearinghouse for all of these other banks. And this idea, all of them start operating on the basis that this is money. But this whole money has been issued on the premise of the king willing to go into a debt. So it's now an IOU. And so with this, we'll end this section, because from this point onwards, money becomes what they know as bank credit. Most of money today is still this type of money. It is issued in the form of somebody willing to go into debt, and the bank will just charge an interest on them at the point they're willing to go into debt, and that interest will always be accrued through competition. In an economic sense, this is known as efficiency. But money itself becomes an IOU, or rather an interest-based IOU. So I'll talk about this in more detail in the next presentation. For now, we'll end this presentation. سبحانك وبحمدك سبحان العظيم والعصر إن الإنسان لفي خسر إلا الذين آمنوا وعملوا الصالحات وتواصوا بالحق وتواصوا بالصبر.